Welcome back to Factful Finance. Are you paying more taxes than you need to? Imagine if you could legally pay less and keep more of your hard-earned money. Well, today's video is going to show you how to do just that, without any shady tricks, just smart, legal strategies. Now, I know what you're thinking. Taxes are inevitable, right? And yes, they are, but that doesn't mean you have to leave money on the table. In fact, the average American overpays in taxes by thousands of dollars each year, simply because they don't know how to leverage the tax code to their advantage. But you're about to change that. Before we dive into the strategies, let me remind you, this content is for educational purposes only. Always consult a certified financial professional for personalized guidance. You should be working with an expert who can tailor these tips to your unique situation. All right, let's get started. First up, let's talk about tax deductions. This is one of the most common, yet underutilized strategies for reducing your taxable income. You see, the IRS allows you to deduct certain expenses from your income, which in turn lowers your overall tax bill. These deductions can range from student loan interest to mortgage interest to even charitable donations. But did you know that business owners can take advantage of even more deductions? Things like home office expenses, business travel, and even meals with clients can be deducted if properly documented. Take Sarah, for example. She's a freelance graphic designer and used to dread tax season. But after a few sessions with her CPA, she learned to track her business-related expenses carefully. By deducting her home office, software subscriptions, and mileage for client meetings, she reduced her taxable income by $8,000, saving her nearly $2,000 on her taxes. Next, we're diving into the world of tax credits. Unlike deductions, which reduce your taxable income, tax credits directly reduce the amount of tax you owe. Think of them as a dollar-for-dollar reduction in your tax bill. There are two main types, non-refundable and refundable. A non-refundable credit means you can only reduce your tax liability to zero. But a refundable credit? That could put money back in your pocket, even if your tax liability is zero. Examples of refundable credits include the Earned Income Tax Credit, EITC, and the Child Tax Credit. Let's look at an example from Henry's story. As a single father, Henry qualified for the Child Tax Credit and the EITC. By filing correctly, he received a refund of $3,500, even though he didn't owe any taxes. That's $3,500 that would have been lost if he didn't know about these credits. Now, that's real money back in his pocket. Another powerful strategy? Retirement accounts. Contributing to retirement accounts like a 401k or an IRA can drastically reduce your taxable income. For instance, if you contribute $19,500 to your 401k, that's $19,500 less of your income that will be taxed. The best part? You're saving for your future while lowering your current tax bill. It's a win-win. Let's look at Ava, who's in her early 30s and starting to save for retirement. Last year, she contributed the max to her 401k and reduced her taxable income by $19,500. Not only does that mean she's building wealth for the future, but she saved over $5,000 on her taxes. This strategy is often underutilized by younger professionals, but Ava's planning ahead, and so should you. And here's one that many people miss. Tax-advantaged investments like health savings accounts, HSAs. If you're eligible, you can contribute up to $3,850 for individual coverage or $7,750 for family coverage. The best part, the money goes in tax-free, grows tax-free, and comes out tax-free when used for qualified medical expenses. That's 3 levels of tax benefits. Now, you might be wondering, but what about the really big fish, corporations and the wealthy? Well, even if you're not a millionaire, there are strategies used by the rich that you can adopt. Take, for instance, the use of capital gains tax rates. If you hold an investment for over a year, you'll likely pay a lower tax rate on the gain when you sell it. This is a strategy used by many savvy investors to keep their wealth intact. Let me show you how Noah did this. He invested in stocks, and after holding them for over a year, he sold them and paid only a 15% tax rate on the capital gains. Had he sold earlier, he would have paid much higher taxes on those gains. By following a disciplined investment strategy, he kept more of his money working for him, and less went to Uncle Sam. It's all about knowing the rules and working within them. The tax code may seem complicated, but the more you understand it, the more opportunities you have to keep more of your money. So what's the bottom line? Tax planning is a year-round activity, and it's not just about filing your taxes at the end of the year. It's about making smart moves throughout the year, whether that's by contributing to tax-advantaged accounts, maximizing deductions, or leveraging credits and tax-efficient investments. I want to hear from you. What tax-saving strategies have you used in the past, or what are you planning to try this year? Drop your thoughts in the comments below, and I'll respond to as many as I can. If this video helped you understand how to keep more of your hard-earned money, make sure to hit that like button and subscribe. We're just getting started with more tips that could change your financial future. And before you go, make sure to check out the next video. It's packed with even more strategies to boost your wealth. Trust me, you won't want to miss it. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance.